Now here we're going to go a little bit deeper in terms of retail, what's happened on the retail side, what's happening with Homebase, Indeed, and then look more further abroad, go into Europe, go into Asia, and really kind of give a backdrop for what's going to happen with GDP going forward now that we've had some new estimates come out. So first we want to turn towards the US retail store, and we want to go back to 2008 because I think the chart is very good in trying to highlight just as we saw the increase in Amazon, Google, just the e-commerce side, it starts off slow and then picks up pace. And as companies try to survive, try to adjust strategies, try to shift really what their profile is in terms of this basket approach, which we talked about with on one of our conversations. Here we see just how things have accelerated and how that continued well before 2020. And that's what we always like to go back to as well. Where were we sitting? Were we on a strong footing prior to COVID? And you can see how the slope was changing and was accelerating upward. And then COVID just became the excuse or the reason used to say, hey, sorry guys, it's COVID, have to shut down, we'll go into bankruptcy, whether that be Chapter 11 or Chapter 7. And, one of the conversations we had prior to jumping on to film was the conversation around Chapter 11 and this fear of bankruptcy, because it's a restructuring. You're still going to operate. If the business is strong, you'll come out on the other side. Some of the people that did it right, own debt, own some, provided dip financing, some other different things, will have a bigger ownership on the other side. And those who speculated will will lose their money, as they should, as they're speculators. So there's something to be said about how is this going to turn over. And trying to protect too much is going to create those zombie companies and this inherent backdrop where we keep talking about lack of jobs. We need innovation. We need new industries to come out and rise to the challenge. And that's really it's going to be hard to do if we have just this stagnant growth or this stagnation where, if you say the other side of inflation and deflation is stagnation, that's almost, the question is that worse? Is that going to put us in this thing where we're no longer going to see innovation because there's no incentive to? And that's going to be a bigger problem. But when we look at retail stores, again, coming down to jobs, these are jobs that just aren't coming back, or they're going to get consolidated because, well, do you need 10 Macy's within a 100 square mile radius, or do you need 3? And that's going to come down to just shrinking that job pool and pulling everyone out. And unfortunately, there is very little places for them to go, which we'll talk about in a second when we go through the different segments. This is just an update on the Indeed data coming through September 25th. You can see we're still at an 18% difference versus last year. You can see we've gotten a small increase from August to September, which anybody who's looked for a job, whether because you were laid off or because you wanted to change jobs, you have an understanding that things start to loosen up and change a little bit as you get into September, October. You normally get more hiring, and then things start to drop off in November, December, and then they pick back up in the middle of January into February. So it's not surprising to see an increase. And given the fact that we're going into October, people are trying to set budgets for not only Q4, but 2021. We should see another increase. Again, not back to zero, but we should get closer to that, only down 15%. The bigger concern is some of this home-based data, which I think does a very good job of kind of highlighting the issues here. Here, the backdrop when we look at employees working, we've started to see this tip down. Now, you're starting to roll over a little bit, and you could say, well, maybe this is more seasonal because we have summer vacation places that are now shutting back down. But when we look at the hiring side of things, when we look at before summer started, as people started to gear back up, there was much less seasonal hiring. So there should be less seasonal reduction. And we're seeing that. So what this is showing is a little bit closer to actual declines in hours being worked and just the businesses that are open, where we're starting to see that rollback. And it's actually greater than the seasonal norm, because even seasonally adjusted, we're not getting those slowdowns. And this is going to be concerning, especially as we continue to have layoffs on bigger companies, because it all bleeds down to, well, if you lost your job at a Marathon or somewhere else, are you going to go to dinner? Are you going to do things that you've done in the past? Not to constantly pick on Marathon, but it's just because it came out. So it's the front and center. So when we look at this, the slowdowns we think will continue, and the home base, it's something that we said in August, and it's starting to show up in the data now. And when we look at changes in employees working, again, that's shifting further down. And we continue to see this pressure, and we think it's going to get closer to that 27%, 28%, especially as we continue to move forward. And those headwinds continue to weigh on consumer spending. And then when we think about, okay, well, what's changes in hours worked? Well, where are we seeing the change? Where is there some benefit in terms of some of these areas? And here, DC, which shouldn't be surprising given, what's been happening in consulting and just the expansion of government jobs. And Arizona is an interesting one as you think about snowbirds trying to avoid the Northeast and maybe never come back to the Northeast given what's happened. But you're starting to see some of these shifts. So to see more hours worked there makes a lot of sense. But when we start to look at other places that should be bigger drivers to the economy, we continue to see these headwinds, specifically across if you look at just the back end going from left to right. The pressures are going to remain, and California, we showed in the earlier segment, how California is slowing, how some of these areas continue to slow. That's going to be a much bigger weight as we go forward because it's just more to be lost, and there's the jobs that are coming out, hours worked are coming down. So if you think about on a percentage level, as California draws down, we'll have a bigger effect versus Rhode Island. And that's why with those hours worked, we think has a downward trajectory, especially as you see some of this rolling over and some of the pressure, especially as we were talking prior to filming, how restaurants that try to survive and now we're forced indoors aren't going to be able to do that just because, weather is not permitting. And some of these guys that try to wait to the other side just are going to have to fold up. Unfortunately, you're going to start to see that turnaround, which will decrease hours worked. Now that we looked at the U.S., let's shift a little bit and look at Europe, because here you might say, well, look at the numbers, the data is not as bad in Europe. But when we look at job postings, the same pressure continues to appear. Specifically, when we look at Germany, France, and as we've been mentioning multiple times, France, Spain, and the UK will continue to have that pressure. And then when we look at the stimulus and the economic strength as we came into the year, the Italy and Spain were already on a back foot, about to fall backwards, and this isn't going to help at all. So the pressure is going to remain here. Germany is starting to see a little bit of a plateau, but again, going back to May, you can see that's all they've hit that level, and it's hard to get that movement back. Just because even though industrial production has started to come back, we've started to see manufacturing PMI spike. Service PMI, specifically in Europe, has gotten significantly worse, and especially against estimates, and it's now back in a contractionary level, which again is going to put that weight, and that's why these job postings just remain very low, and I don't see that coming back at least through the remainder of Q3 into Q4. Now, when we look at just the industry performance overall, looking at the U.S. again, here you can see just the 12-month change and how things have gotten fairly worse. Construction has gotten stronger, which if you consider the amount of homes being built, some of these different pieces, you're starting to see some of that return. The manufacturing side is interesting because as we keep talking about manufacturing PMI getting better, some of the Chicago PMI, some of these other just indices have gotten better on the manufacturing side in terms of getting back to growth. It's not really showing in the jobs data. And it's really because people let go individuals and now they're figuring out ways to do more with less. And if you consider how hard it is to let someone go or the case you have to build around it, you could just use COVID. It was a very cheap, easy way to say, hey, sorry guys, COVID, here's your package, best of luck. And that's what we're seeing in some of these areas, which is going to remain a problem as we start talking about jobs and how this leading indicator or how these indicators are going to shift because they're just not going to be the same type of spending. And when we look at the regional side, it shouldn't be a surprise that the West continues to struggle, especially given some of the pressures that we've talked about, which is why when we look at California, the Northeast, when we start talking about New York and some of these other key urban areas, the urban areas continue to lose not only people, but jobs and just, industry overall. And those industries continue to have that knock-on effect, because if you don't have a headquarters in Midtown, then the restaurant down the street or the cleaners or something else just won't have the clientele to survive. And that's the knock-on effect, which is still reverberating through the system as companies run out of their PPP, small business loans, and other types of mechanisms to try to get to a growth period. And that's when we start to look in those decreased hours by sector. And we want to look again in the EU. So we're bouncing back and forth because we want to keep showing on how this isn't just a US problem. When we start looking at GDP growth, when we start looking at these impacts on a global level, you can see on how it's not surprising to see where the decrease in working hours really are, how construction has remained relatively stable, has started to slow down, transport has slowed down, but it's the total EU 27. So we want to look at this in terms of the total percentage, and there's been a 37% decrease in working hours. And that is going to be a general problem. Now, even construction, which has gotten a little bit better, again, doing more with less. So even though things may show on a manufacturing, industrial, construction side have gotten a little bit better, you're doing it with less workers. So the net working hours have come down. Commerce and hospitality, not surprising. Transport, not surprising when we consider MTA, just mass transit on just a global level. People want to avoid those impacts. And again, those things are continuing to show. But the public admin, financial services, places that usually have a bigger, salary are hurting the most, and other services. If we keep talking about this bifurcating economy of manufacturing getting better, financial or services in general getting worse or not recovering the same way, that's where we're seeing that overhang, which is why we can't really get too confident, especially as we have a resurgence of COVID, people adjusting spending patterns. That's going to be a bigger problem. And then when we think about those big things that people are buying, like the autos, when we look on a global level, we had that huge drop looking at Google Trends, Google searches. Then all of a sudden we had a huge drop in people not looking for cars. You're like, look, let's just stay home. Now you had people moving out of urban areas. What do you need when you move out of an urban area? A car. Now we're starting to get to the point where cars searches are coming down. People have, that first wave buyer is now gone. The incentives may have come off or expired. Some of these, we keep talking about key factors. So let's break this down into, using cars for an example. One, we talked about how lending requirements were tightening. So that means that the people weren't going to be able to get jobs. We talked about the actual companies maybe not getting the same type of rates that they were in terms, and they weren't able to pass it down. So then those incentives went away. And then you saturated the people who could buy a car, did buy a car. So now you took out those first movers. Now what? And that's where we're looking at some of these trends, because these are big consumer goods. A car, what does it consume? It consumes plastics, metals, leather, other types of electronics, chips. As this comes down, we're going to see this wave on the whole supply chain, which is why we keep talking about exports, imports, what's happening overall. And we think this is just a very good way of kind of honing in on just an example of slowdown, which is going to reverberate and talk about why we remain net concerned on those levels of manufacturing, because what's manufactured more than a car? So now when we think about foot traffic and just the shift, again, I thought this was a great chart that we showed last week. And I just wanted to highlight just again the UK, that UK dip, the French dip, and again coming back to people just adjusting their patterns of buying to avoid COVID exposure. And this is something that we continue to see, and we think is going to continue to move lower, where Germany has the support. I don't think Germany really gets back to flat. It's more along the lines of hitting that plateau as we continue to talk about overall. And as we keep talking about Italy and Spain, and not to always pick on Italy and Spain, but I guess you could say they deserve it. Italy and Spain is going to be the biggest beneficiary of the EU recovery funds, which is why it's so key. But when you start digging into the recovery fund, what does it mean? How is it going to be deployed? You can see here it's being deployed in ways that are weighted towards Italy, Spain, France, but the commitments, are they going to come too late? Are they not going to be enough? Do they have to be paid back? It won't be enough. It's not going to the right places. And this is something that we're starting to see that's increasing and is starting to make people concerned when you consider the fiscal stimulus, the lack of stimulus overall in terms of trying to reignite, especially as in the second segment, we talk about tourism, how tourism has fallen. Biggest tourism sectors in terms of economic GDP throughput, Spain and Italy. So now you're starting to see how the pain is going to continue, and this just won't be enough to close that gap. Now, when we talk about, just a global backdrop of places to watch to kind of get a sense of exports, imports, we wanted to pick on South Korea a little bit because South Korea had a slew of economic data come out, and you can see the trend continues to whittle down. When we look at manufacturing, on that orange line, you can see it's at -7. When you consider same-store sales, again, looking back to the consumer continues to struggle. And then how is that being reflected? Well, let's look at electricity generation. I'm mining. Let's look at just what is the overall mining, manufacturing, electricity, gas. You can see, again, down 3%. Same-store discount store same-store sales down 2.3%. Department store sales down 6.5%. Again, a weakening consumer, which is just the narrative on a global level, especially as we had coming back to the manufacturing. We did have a decent survey of 68. It was a little bit stronger, but when we look at the non-manufacturing, again, it disappointed to the downside, and you're starting to see that roll over, coming back to weakening consumer, weakening exports, which is going to be an overall problem, which the exports will be released. Now, before we wrap up with a summary of GDP, I just thought this chart was funny in terms of China. And if you look at how very continuous those numbers look and how, they just had one quick blip and they were right back to normal. Okay, if you want to buy that, we're in the next segment, we're going to go through a bit more depth in terms of piecing apart different pieces of what makes up the Chinese economy and why some of these numbers would appear more fabricated. Now, we want to just pick apart for a moment where we saw some growth, where we saw some of the weakness. Non-manufacturing, there are apparently bucking the trend. They're up 55.9%. Manufacturing is actually lower at about 51.5%. All of them were shockingly above estimates. And the total PMI output was 55.1. Again, it's going to be hard to say that it's difficult to say that this is real given what we know is happening internally. We're going to get a great kind of bellwether as to what does Golden Week show, what is happening with sales, because as we have seen, and we're going to show in the next segment, how tourism, specifically Chinese tourism has fallen off. So here, when we look at GDP, two of them that were taken higher was U.S. and Canada. We saw a tick higher. Again, it's going to come down to that personal consumption, which we saw move, which drove this or was helped support why this was adjusted. The core PCE quarter over quarter was a little bit better than expectations at only negative 0.8%. But the personal consumption in Q2 was revised up by almost a full percentage point. So again, it's giving some confidence, but as we keep talking about week back to school, weekend to summer, some of these COVID increases, we remain cautious. We think that these will be revised lower again. But again, just something to watch, especially when we start looking at Italy. If we look at 18 into 19 into 20, why we think those issues are going to remain a problem. And then when we look at India continues to face headwinds, and China is apparently going to grow. Okay. But, the ones that we want to look at here are Russia and India. And when we turn to the GDP growth on an aggregate, you can see why Russia becomes more of a concern as we see weakness in rubles. We see them trying to get more dollars by increasing exports, coming back to that kind of OPEC plus friction that we think is going to start to ignite. And then when we look at just the general world growth at about down 4.2%, the G7 down about a little over 7%. those are going to be the issues. India is the one that concerns me the most, where I think there could be the most downside resurgence, which again would weigh the most on oil demand as well. Now, in the next segment, we're going to look at a much deeper into not only U.S. trade, but also U.S.-China trade, and how is that going to look as we head into Q4 and what should be the first year of the trade deal.